5 Crucial Points for Startup Investors. Every year, hundreds of thousands of new enterprises are established. Many of them are in desperate need of cash, which presents chances for investors. While startup investment is not for everyone, individuals with a high risk tolerance may find it to be an interesting and possibly profitable activity. The prospect of getting in on the ground floor of the next Uber or Facebook, however speculative, may be appealing. Assume you learn about an amazing new firm that is searching for investors. You are aware that the majority of companies fail during the first few years, but you believe this one will succeed. What are you going to do? 1. Examine the management. You are ultimately investing not in a product or a concept, but in the people who operate the business. No matter how creative or attractive a business plan appears to be, it is unlikely to thrive in the absence of skilled management. Not only should you evaluate the founders, but also those pushing the investment. Often, a first review may be completed online. You may verify the status of people with professional licenses, such as brokers, accountants, and attorneys, as well as any disciplinary histories. You want the people operating or involved with the firm to not only have a clean record, but also a track record of success in prior initiatives. Experience, intellect, creativity, honesty, discipline, and leadership are all desirable characteristics. 2. Figure out how the company will make money. Many businesses are founded on an appealing notion. However, the firm must be able to transform that notion into a product or service that it can profitably create and sell in sufficient quantities to generate adequate cash flow. What is the startup's plan for monetization? What is the current market demand? Is the company scalable, meaning that it can expand quickly without losing quality or profitability? If the firm is unable to offer satisfactory answers to these questions, its chances of success are slim. 3. Consult with advisors. If you are purchasing a used automobile, it is a good idea to hire a technician to inspect the vehicle to ensure that you are not purchasing a lemon. The same logic applies when appraising a startup. It is critical to work with experienced experts such as an attorney and an accountant. Make sure your advisors are knowledgeable with startups. An attorney who specializes in personal injury lawsuits is probably not a good fit. You should also seek advice from professionals in the business field in which the company works. Your advisors will supply you with information that you would not have gotten otherwise. They will also assist you in commanding the company's respect. 4. Conduct extensive research on the startup. Ask a lot of inquiries and make a lot of requests for documentation. If the company is concerned about you disclosing private information, it might require you to sign a non-disclosure agreement. You and your advisor should carefully review the startup's business strategy, offering memorandum, financial statements, budgets, capitalization table, and corporation papers. If the documentation are sloppy or missing, this is a red flag. Internal financial statements should be avoided. Statements made by an independent CPA have higher credibility. Audited financial statements are the finest, although they are less prevalent due to their cost. If your inquiry raises red flags, demand full explanations. 5. Examine the investment documents. Your advisors can be of tremendous assistance here. At the absolute least, you should be fully informed about how the transaction is structured and what rights and duties you and the corporation will have. Your attorney can advise you on whether document modifications are in your best interests and assist you in negotiating with the corporation. Your accountant will be able to tell you whether the valuation appears to be realistic. Do not proceed unless everything has been thoroughly recorded. You should not make an investment based only on a handshake or verbal guarantees. Patience and hard effort are required when investing in a startup. Although there are no guarantees, adopting the concepts outlined above can help you decrease risks and increase your chances of success.